Hello investors, welcome to Simpli Stocks. Over the past 1 to 2 weeks, the market has seen a very strong pullback rally. Although things are getting serious again with the recent developments, the US has attacked Iran's cargo ship, while Iran has also decided to back out of the second round of talks. Let us see how things continue from here. Performance wise, you will see both Nifty large mid cap 250 and small cap 250. Both indices have rallied around 10% each from their bottom. This is a good time to buy the dip, regardless of in which direction the market goes. Because in my opinion, if there are no further negative surprises, the market should gradually recover from here. At the same time, if there is any negative news, I think the market is also sort of saturated right now. So we may not see that extreme correction the way we have seen, the way we saw 2 weeks ago. So in today's video, I'll discuss with you some strong business models from a long-term perspective, which you can explore in the current environment. Right now, these stocks have corrected a bit, but from a long-term point of view, these businesses should do well after this short-term uncertainty ends. But yes, as a standard disclaimer, this video is not a buy or sell recommendation for any of these companies. My purpose here is to give you a framework so that you can go and study these businesses on your own. Also, it is possible that I may be invested myself in some of these businesses. So please keep that in mind as well. With that, let's get started. The first business we will cover is Tata Group's IHCL or Indian Hotels Company. IHCL had touched its all-time high in January last year, and since then it has been underperforming. Right now, the stock is trading at around 25% discount from its peak. If you look at it from an EV to EBITDA point of view as well, it is at a low valuation. IHCL has come back to its 3-year-old May 2023's EV to EBITDA multiple, because what happens is during geopolitical tensions, hospitality stocks are the first to get affected, or they are the first to take a hit, and the entire FY26 has been a dull year overall for these businesses. In Q1, as you know, there was Operation Sindoor. Then just as the sector was recovering, there were Indigo's mass scale flight cancellations in early December, and by the end of February the war started. Plus, hotels are leveraged and asset heavy businesses, so they take double hit. On one hand, there is a loss in revenue, while on the other, as costs remain the same, whether 50 rooms are booked or 100. So because of this operating leverage model, the impact on profits is even more significant. At the same time, you also need to understand that this uncertainty is for the short term. The hospitality and the hotel sector and the brands like IHCL or say Taj, they are not going anywhere. In the mid to large cap space, IHCL is one of the best bets, and you know how powerful the Taj brand is, right? And right now you are getting such a strong brand at such an attractive valuation. Also, it is not like you are just bottom fishing in IHCL because the price is low right now, or basically it has become a good opportunity because it has corrected. Even from a medium term perspective, there are multiple triggers playing out in IHCL. Currently, they have around 32,300 keys or rooms, and they are planning to nearly double their capacity by adding another 30,200 rooms. Taj is also coming up with a premium property at Mumbai's Bandstand, for which the company is doing a significant capex. Apart from this, they have also acquired the Bridge and Atmantan chains. This business, so overall ISCL, this business can grow in the double digits in the medium term, around 12 to 15%, and a 12 to 15% top line is considered good in the hotel space, because as hotels benefit from operating leverage, this easily translates into profit growth of around 20 to 25%. Also, the hotel sector itself is going through a good growth phase. In prime hospitality markets, demand is actually higher than the supply right now. There is not enough supply. So because of this, we are seeing very healthy RevPAR growth. RevPAR growth basically means how much hotels are increasing their room rates every year. For instance, right now, room rates are going up at a healthy rate of 10% every year. Like you can see here, even in Q3, IHCL reported RevPAR growth in the range of 8 to 10%. So with around 10% RevPAR growth and 5% type capacity addition, IHCL becomes a solid 15% type growth business. Plus, Taj is also a very strong brand. Yes, the sector has faced back-to-back setbacks or challenges in the in the last 1 year. However, what you need to focus on here is the long-term potential of the business and the sector. And all the 2 to 3 years, I think the sector has strong tailwinds, which should continue to benefit it and players like IHCL. Now, moving ahead, the next discounted business we will cover is allied blenders and distillers. Due to gas shortages, glass manufacturers' operations are affected, which will directly impact the availability of bottles for alcohol companies. This is the, let's say, broader consensus. Here as well, the same logic applies that these are short-term problems because of which you are getting a quality moated business at a good discount. You would know that in the alcohol sector, licenses are required at every stage from production and distribution to retail. This makes it very difficult for new players to enter. That is why you will see alcohol stocks always trade at premium valuations. Now, because of the glass bottle shortage, ABD has corrected around 20% from its peak. We track this business closely in our Simpli Stocks community too, and we have also covered it 2 to 3 times on our channel under the premiumization theme. It has recovered a bit now, but I was seeing earlier it was trading at nearly 40% discount. And you would know Officer's Choice and Sterling Reserve are two well-known whiskey brands of Allied. Apart from this, they launched iconic whiskey 2 years ago, which has been quite successful, and it has also brought good growth for them. Allied has launched several, several new products across its super premium to luxury portfolio. These include Russian Standard Vodka, Zoya Gin, and Woodburn's whiskey, among others, which are currently performing well. And actually, this very premium alcohol portfolio is the key trigger in Allied. Premium alcohols have margins of up to 40%. That is why I am not much worried about the glass bottle shortage or increase in the prices of glass bottles, because Allied can easily absorb any such cost inflation in the near term. And ABD is also investing around 525 crore rupees to expand its ENA, malt and PET bottle manufacturing capacity. Once this capacity comes online, it will also help to improve their margins. Currently, Allied's EBITDA margin is around 13%, and their target is to increase it to over 17% by FY28. This 4% margin improvement can significantly boost profitability. Around 2% of this benefit should come from the free trade agreement with England. With FTA, Scotch whisky has become cheaper in India, and since it is used as a raw material in premium alcohol, it should support margins. At present, their ROCE is around 17%, and they have a target to increase it to 23 to 25% in near term. So broadly, if we assume around 15% sales growth along with 4 to 5% margin expansion in ABD, we should see more than 30% CAGR growth in bottom line or net profit. So ABD is also a strong premium moated bet that you can consider studying on your own during this correction. Now, a humble request just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week, because honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Now, coming back to our discussion, the third and final business you can explore in this correction is Nuvama Wealth Management. During market corrections, businesses related to capital markets obviously also take hit. And at the same time, such corrections also create good opportunities to buy dip in these businesses. Now, Nuvama offers a wide range of services related to stock market and investments. It primarily caters to HNIs and ultra HNIs, providing them investment and portfolio management services. Apart from this, it also helps companies to bring IPOs and in raising funds. As market recovers, this segment of fundraising, it should come back into focus. Additionally, through its asset services segment, it also provides custodian services, or say safely it holds and manages funds for FIIs and DIIs. Now, see, recently ICICI AMC announced its results. I was going through them. their results have been good. And in their investor presentation, I found two interesting slides. I'll show you here. So in this screenshot, you can see that the mutual fund industry's average AUM has grown by around 21% over the past year, and closing AUM has grown by around 12%. So this is quite a strong growth, especially considering that the market itself delivered negative returns over the past 1 year. Similarly, you will see in another slide that PMS and AIF segments have also seen good growth, with AUMs increasing by 25% plus and 45% plus respectively. So this is quite interesting. In previous corrections, people used to pull money out of the market out of fear. But this is new India, and the new India is actually buying the dip. So seeing this, I hope that other asset and wealth management companies should also report good results. And once the market stabilizes, this segment can also recover and perform well along with the broader market. Now, the wealth management itself is a growing market in India and is seeing very healthy growth. Like if you can see here that in the last 5 years, FII money has grown at a CAGR of 24%. Similarly, assets under custody for hedge funds and PMS have grown at a CAGR of 50%. Apart from this, the number of HNIs and ultra HNIs is also increasing rapidly in India. Because of this, wealth management market itself can become 3x over the next 5 years. And the alternative investment market, meaning investments other than the stock market, that market can grow 5x over the next 10 years. So this is a strong, fast growing sector, and Nuvama is a good business that you can consider exploring in this space. Right now, the stock is trading at around 24-25 PE. You can also explore, I'll say, other businesses within the capital markets theme. But personally, I feel there is a valuation gap in wealth management companies. Most other capital market related businesses are already trading at premium valuations. So the upside there is limited, but up to you, whichever business you want to explore. And I have made separate dedicated videos on the other 4 businesses, the discounted opportunities which you can explore, and I will share the links to those videos in the description below. You can check them out from there. All 4 of them are unique, special business models, each with a strong, let's say, moat in its respective space, and they are also currently trading at attractive valuations. So don't forget to check out those businesses. And lastly, if you like this video, do make sure to hit the like button. A lot of effort goes into creating YouTube videos, and your support will help us to continue bringing such high quality research every week. You can also subscribe to our channel Simpli Stocks so you get updates on all our videos. I'll see you in the next video. Happy investing.